Hey everybody, welcome to Mortgage Today for Monday, October 30th, 2023, and oh, what a day it was. UMBS started the week down 11 basis points bright and early this morning. S&P futures were up 24 points. The uncommon combination of events in the market potential for this week is hard to underestimate. Each layer is important in and of itself, but they combine to form something unique. Layers include the typical important slate of early economic data like ISM, JOLTS, ADP, NFP, jobs, a Fed announcement that may all but confirm the ceiling is in, the quarterly announcement of Treasury auction sizes, and a Bank of Japan announcement that may well produce another policy change that impacts U.S. rates, all against the backdrop of an ongoing technical test of the 5% ceiling on the 10-year yield. Wall Street Journal Fed whisperer Nick Timaros suggested that the big increase in the long-term yields over the past 2 months gives the Fed the leeway to stop hiking rates, as the jump in long-term rates has the effect of 2 or 3 rate hikes by the Fed. The December Fed Fund futures are a lock for no change at this week's meeting, and they have been quietly reducing the probability of a hike in December. We now stand at a 25% chance of a rate hike in December versus a 33% chance a month ago. Friday's job report will probably include some noise from the UAW strikes. It looks like they have an agreement in principle with the big 3 automakers. The UAW was able to get a 25% increase over 4 years and automatic cost of living adjustments. The union was seeking a 40% increase, while the auto companies were offering 15%. The union demands for a return to the old social contract, including defined benefit pension plans and a 32-hour work week, though getting paid for 40 hours didn't go anywhere. Also note that pharmacists are going on strike, as well as CVS and Walgreens soon. In the afternoon, we got the news that the U.S. Treasury says it expects to borrow $776 billion in net marketable debt for the October to December period, down $76 billion from the July estimate. This marked a slight decrease in Treasury issuance. This is one of the 2 releases that bonds were waiting to see on the topic. The other arrives Wednesday morning, but it is made less threatening by the overall decrease in issuance. 10-year yields rallied a couple of basis points on the news. On what has the potential to be a momentous week, the bond market has cleared its first major hurdle and is no worse for the wear. The Treasury released the first of 2 issuance announcements this afternoon, showing a 76% decrease versus the July estimate. That decrease should be partially finalized on Wednesday morning when specific auction sizes are announced. Bonds have been slightly weaker in advance of the news and made modest gains in its wake. It is best to think of this outcome as a cleared hurdle as opposed to the race being won. There are more challenging hurdles in the coming days. Those will determine the race, but it's a good start nonetheless. Events and volatility potential only increase from here. The UMBS 6.5 closed down 5 basis points at 99.27 today, and that 5-year ended up at 4.818. But using that price at 99.27 puts us in right below that Fibonacci line there, which is well below our 2550 and all the other moving averages. Got another interesting piece of information I saw today from National Real Estate Post. This says that in September, the percentage of auto borrowers who were at least 60 days late on their bills rose to 6.1%, according to Fitch. That marks the highest default level in nearly 3 decades and is a notable increase from the previous record of 5.93% in January. So people are starting to miss their bills. And then we also got some industry news here. Mr. Cooper Group announced a Q3 net income of $27.5 million, edges closer to its $1 trillion target. So it's getting really close to being a $1 trillion servicer.